Hey everyone, it's Imran from Options Insight with your macro options spotlight for today. Okay, so market's ripping up quite a bit, 1.5% in the US indices, Nasdaq and S&P having a good day yesterday. And this often tends to happen as we go into a holiday like Thanksgiving or even Christmas holidays. You often get markets kind of trading up on not massive volumes. The question really will be if this gets faded once we come out of the other side. We have got Powell potentially speaking, due to speak next Wednesday. So it's in about a week's time. If the market gets ahead of itself on the upside, maybe he's going to come out and say something hawkish and knock it back down again. We'll have to wait and see. We're trying not to get too lost in the noise of markets winging around and things kind of decorrelating a bit from their normal correlations. And we're just taking a bit of a step back as we wait for that crucial December macro data that's going to kick off in early December. Volatility wise, if we look at vols, down pretty much across the board. So you can see, let me just highlight here. So we've got Euro stocks down a vol, European vols down nearly a vol point as well. China getting hit, Japan getting hit, India getting hit, and that was already from a low level down to like a 12 handle now. So vols just getting smashed across the board. Also seeing similar thing in commodities. Most volatilities hit, all except the good old natural gas that just doesn't want to go down. So natural gas vol now 117% in the 1 month. Realized vol is at 45. Carry is getting ridiculously big, but the thing just keeps charging and rallying one way. Natural gas is now up 50% odd over the last month from the lows that it hit literally about a month ago. Just in the last week, it's up 15%. But you look at these moves in the context of the implied vol. I mean, a 5% move yesterday is not a one standard deviation move, right? It's a 2/3 of a standard deviation move, which again, for those people who are brave enough to sell natural gas vol, it seems to be quite expensive still. Now, that's not to say something crazy can't happen and it can't explode 20% in a day. Very, very possible still. But from our perspective, we are short some strangles on the books. And we think that with these levels of vol, we can manage that position relatively well. Granted, it hasn't made us any money yet because this thing just keeps on ripping 5% every day. But in the context of how far away our strikes are when you sell this vol that's so expensive, we think it's quite manageable still. And then in terms of carry, other than nat gas, which you already mentioned, oil's got a bit of positive carry, as has silver now. And the VIX as well, it's got a positive 10%. VIX vol was the only one really bouncing outside of natural gas. That was up 2 points yesterday. It has come down a bit. It's down about 9 vols on the week, but the realized in there is at about 52. In terms of skew, pretty mixed, but we were seeing Nasdaq and Russell skew bid, whilst we saw European skew offered. But in general, skew still, you can see equity skew all in those lower percentiles, nothing really changing there. In terms of commodities, generally we're seeing put skew softer on the day across the board in commodities, as we do see spot rallying across commodities with the dollar weakening. So that's generally the way things were going. Okay, if we then move on to FX and alike, we've got dollar obviously weakening across the board. Generally tends to happen when you get better risk sentiment. Bonds also had a strong rally. You had TLT up 1.5% on the day. So that's a pretty strong move in TLT. And we are seeing that bonds are starting to trade better. Whatever stocks do, bonds just seem to be trading much better at the moment, right? So there might be a bit of a decoupling going on there. We mentioned the correlation between stocks and bonds this year. We can see if inflation is rolling over, then that is going to decouple and could well be quite good for bonds on a relative basis. Commodities sectors, however, if we look at those, they were up 3% apiece. Metals and mining and XLE. They're now attacking recent highs again, and they may well be imminently about to break out. So keep an eye out on those sectors. And then ARC, not really managing to rally. So despite strength from the likes of Nasdaq up 1.5%, you just didn't see ARC participate. So some of these high growth speculative tech names not managing to rally. That's even with bonds rallying. And it's even with crypto stocks rallying. Some of those crypto stocks that have been beaten up really, really hard over the last week had a bit of a bounce. The likes of Coinbase, the likes of Mara, all having a bit of a bounce. Yesterday, we do have positions in those. Those who are subscribers to the overlay portfolios will know that. So those finally having a little bit of a bounce, which is kind of what we were looking for. But we'll see if that continues. We're also seeing some of these cryptos bouncing, like Solana hit a low of 10.5. Is now back to around 13. So showing a little bit of resilience there. Doesn't mean the tide has turned yet, but when things are so beaten up and things are so bearish, you shouldn't be that surprised to see some kind of dead cat bounce. Okay, volatility-wise, vols were generally softer in FX, in line with the broader trend in cross-asset vol. TLT bucking the trend a bit. As I said, it's been trading quite firm, and the vol has been firming up as well. So we have got that up half a vol in the face of everything else sold, and those sector vols really getting trashed down about 2 points on the day, in line with what equity indices have been doing. Nothing new to really say on carry in terms of this bunch of assets, and then even skew mostly unchanged. We did see HYG skew a bit softer, as spot rallied quite hard on that risk asset strength, and then XLE skew getting hit. As I was saying, a potential upside break in XLE looks quite imminent. Having said that, oil is trading softer today. It looks like this kind of price cap from what the EU were doing is not going to have a material impact on what Russia can export in terms of oil, and so the oil market kind of retracing a bit down on that news. Okay, what else are we looking at? Yield curves. So obviously yield curves have been inverting all year, depending on which part of the curve you look at. And the question, on my mind is, which yield curve really matters the most? Okay, so people have been talking about, and Jim Bianco put out a thread on this recently, a really good thread. He obviously, I'm sure you already follow him, but if you don't, he's a must follow. He puts out some good stuff around rates and inflation and all that stuff. But he's pointing to the idea that this 10-year versus 3-month yield curve has got a very good track record at predicting recessions. Okay, so the idea being that if you do get an inversion in this 3-month rate versus the 10-year yield, and that persists for longer than 10 days, then for every observation that's happened going back to the 70s, we've always had a recession after that. Okay, so it's a pretty good hit rate. Now, the Fed was questioned about this point, and they had even cited this yield curve before when the 2s10s inverted first time around. Oh, yeah, the 2s10s doesn't matter. It's really this one that matters. And now that this one's inverted, they've shifted their focus to a new Fed yield curve, as Jim Bianco puts it. And they look at the implied forward rate 18 months into the future for the 3-month rate versus the current 3-month rate. And they see if that's inverted, basically, right? Now, the reality is, whether that inverts or not, who knows, and what it means. There's not as much studies or back testing done around that inversion to really say much. And to be honest, even on the inversion of the 3-month versus 10-year, it's 8 observations, right? So it's not really, can that be called statistically significant when you've got an 8-sample data set? I don't know. But anyway, the point being is that the Fed just keeps changing the goalposts to fit whatever narrative it is they want to use. And the fact is, admitting that they need a recession to achieve their inflation goals, and it looks like they're getting one, is not the chosen party line right now. So that's, I think, what the reality is. And generally, these inversions in these curves tend to tell us, yep, a recession is kind of nailed on now, yet they don't want to openly admit that, and they want to kind of give people the hope that they're going to be able to engineer a soft landing. Remains to be seen. But if I'm honest, I'm quite skeptical about that. Okay, moving on. What are we looking at in vol space? So we're looking at European markets today. They've had more than a 20% rally off the bottom. This is the Eurostoxx chart here. And what we're seeing is, whilst we are eking out some new highs after that big gap higher on the CPI, the momentum of the rally has really collapsed. And we see that in this momentum indicator that I track, and it's showing lower highs as we're making higher highs in spot. So that's what we call a bit of bearish momentum divergence. Okay, and often when you see these momentum divergences, they kind of signal that you may get a bit of a reversal in the trend coming. Now, we had a good rally, like I said, 20+% off the lows. If we were to retrace down to the 61.8 Fibonacci, that would get us to around 36.80, which is a decent pullback from here, right? It's about a good 250 plus points, which we're looking at about 6% retracement from these levels in Europe, which I think is quite realistic. So we think that that's probably on the cards, some sort of correction in Europe, given the technicals, given that a lot of people have been squeezed back into Europe because sentiment was bearish. No one really owned it. It looks like the energy crisis took a pause, and the idea being that people were forced back into that market when they were covering shorts. So we think that's what's driven the rally. Well, and we also think a nasty recession is kind of the base case for Europe still. They've got a tight ECB that's being forced to fight inflation. We see we're not seeing inflation come down anywhere near as quickly in Europe as we've seen in the US. It's a structural inflation driven by supply side issues rather than demand side, which is what we've seen in the US. So we think the EU economy is ultimately still going to be under pressure. We think earnings are going to get hit. We think stocks are likely going to get hit. And like I said, the energy crisis, we think is only in intermission rather than being completely over altogether. And if we do get a snap of cold weather coming, which it looks like we're starting to see, then that could, that sort of news could hit natural gas prices again, and people could be concerned about Europe again, basically, right? So things could turn quite quickly. Anyway, so how would we play that? So we look at the volatility dashboard in Europe for Euro stocks, and it looks pretty similar on the DAX if you look at that as well. But generally, the volatility is a bit cheaper in Europe, so it's at 17.5. You can see this is the curve. So it's collapsed quite hard over the last month. We've got an upward sloping contango, and we've got these December options at what look like pretty cheap volatilities, right? So you can look at the implied vol, it's sitting here near the bottom of the range. Obviously, if we go back all the way to sort of late last year, it did get lower, but this year's been a slightly different vol regime. So we'll say we're at the bottom of the range in terms of vols. We look at the spot is at the top of the range, at the top Bollinger Bands. Like we said, it does look quite overstretched and overbought here. And we're seeing those divergences, which are making us more bearish. Our strategy compass is obviously pointing to the buy puts territory, which makes sense because vol's low and spot is high. Skew-wise, skew's not far off the bottom of the range. It has bounced, obviously, those who have been watching the show every day will know. Skew has bounced off the lows, but it's still in the kind of broader context, still quite close to the bottom of the range, which suggests that buying puts is the timing on buying puts when vol is low and skew is low. That's when you want to tend to be buying puts generally for your protection. And then lastly, the carry indicator also showing that this market is moving. So relative to its realized and implied vols, it's doing okay. So vol doesn't need to imminently collapse from these levels because it's already priced cheaply enough, basically. So that's what the strategy compass is saying. So then the trade we're looking at, we're keeping it simple. All right, that's it for today. Have a great Thanksgiving break. For those of you who are in the US, I'm also taking a break as well, as you know. So you won't be getting a daily off me until next week on Wednesday. But you will get a crypto next week. So we're still going to keep an eye on crypto markets over the weekend and see what's going on there. All right, thanks for listening, guys. And I'll catch you all next week.